Good afternoon. Happy Friday. This is Craig Modelmog for this week's episode of Wall Street X's and O's. Today is Friday, August 28th. The month is gone, basically. And welcome. I hope everyone's had a great week. Hope everyone's had a great month. To kick things off, the standard disclosure here, the opinions and facts on this show, opinions-wise, are mine. They are not an offer or a solicitation to buy or sell anything. The facts are believed to be true. I really work hard on getting them from very reputable sources. But again, you should fact check me. That's the big thing now with all of the DNC, RNC. Fact check. You can fact check me. What you'll find is my facts are 100% accurate. Why would anyone present a fact that's not accurate? I digress. Anyway, to kick things off, I've got a great show today. We're going to talk about changes upcoming in the Dow Jones Industrial Average. We're going to talk about the national debt, the unemployment. I have to have an update because that's driving a lot of things. How income and spending continues to be very dependent on government support. Banks, are they part of the solution or the problem? Inquiring minds want to know. And then finally, we're going to talk about the Fed's most recent commentary on inflation. So to kick things off, the Dow Jones, a little history lesson here. You know how I love history. First calculated on May 26th, 1896. It is the second oldest stock index in the United States, next to the Dow Jones Transportation Index, which dates back to actually to 1884. And I said 1896. If I said 1996, subtract that minus 100. The editor was Charles Dow, who was the editor of he was actually the creator of this. Charles Dow was the editor of the Wall Street Journal, and Edward Jones was a friend of his, was a statistician. Say that fast on a Friday. Statistician. That's a hard word, even on Monday. Anyway, lots of changes. 3 companies being added, 3 companies being removed. Let's go back and look. Initially, there were 12 companies that made up the Dow Jones. Again, back to the history piece. Those 12 were, and I'm going to ask anyone if you've ever heard of these companies, email me and say, yeah, Craig, I've heard of that company. I'll probably call full bull on that, but because I didn't know very many of these personally. But we're going to go from here. American Cotton and Oil, American Sugar Refining Company, American Tobacco, Chicago Gas Company, Distilling and Cattle Feeding Company, General Electric. There's one. Locklade Gas, and I probably just butchered that because I don't speak English very well. National Lead, North American Company, Tennessee Coal, Iron and Railroad, U.S. Leather, I bet you've heard of that one. And last but not least, United States Rubber. The 3 companies leaving the Dow Jones, I'm going to tell you which one's leaving and what it's being replaced by, because this is kind of interesting. As of Monday, and this kicks off Monday, you have ExxonMobil being replaced by Salesforce.com. We have Pfizer being replaced by Amgen, and we have Raytheon Technologies being replaced by Honeywell. Fascinating. Yeah, very, very interesting. On to the national debt. There's this huge controversy. I don't think it's a controversy. It's just how you want to look at this. Is our national debt 26.7 trillion, or is it only just a hair above 20 trillion? It really depends on how you look at it. There are really 2 components to our national debt. You have debt held by the public, and you have intra-governmental debt. Well, Craig, what's the difference? Well, debt held by the public is just that. It's U.S. government debt that is held by individuals like you and I, foreign investors, U.S. foreign corporations, nonprofits, foreign governments, mutual funds, institutions, etc. That number as of today is just a hair over 20 trillion. If you look at U.S. intra-governmental debt, that represents another 6 trillion. Okay, or basically about 25% of the total outstanding debt, which is owed by various government agencies. Okay, so what that means is this: is the true number 26.7 trillion? It actually is, if you really look at all of the debt collectively, which that's the best number to use. If you want to go to a really cool website called US Debt Clock, you will see that our current debt And going up is 26,693,878,500. It gets because it's going up, so I just stop right there. It's a lot. Okay. Here's what's anticipated on happening. More than likely, that number is going up. Why? Federal government is going to continue to buy stuff. Congress is going to continue to give money away, thus doing what to the debt? Going up. Going up, I tell you. Unemployment, let's move on there. You know what? We didn't crack a million this month. We were 1,000,006. We were down modestly week over week, but let's face it, there's still 1 million new claims this week. Okay? That's serious. That's a significant number. If you look at PUA claims, they rose. They were up to 608,000 for the month. So that was an increase of 82.8 for the week. That's crazy. Second straight week, but that's going up. Okay, now also remember this is a lagging indicator, so that's most likely going to add some to the total number that we get to next week. If you look at total claimants, which again is 2 weeks lagging. So if it's 2 weeks lagging, this most likely means that next week, this 27.2 million is doing what? It's going up probably, most likely. If I was a betting man, which I'm not, my guess is it's going up next month. So 27.2 million people are in some form of reoccurring government unemployment assistance. Here's what's interesting. If you go back to February, I'm looking at February 14th numbers here. February 14th, you know how many unemployment claims we had for the week? 215,000. The week of the 21st, 220. The week of the 28th, 217,000. The week of March 6th, 211,000. And pre-pandemic shutdown, March 13th, 282. We're working on 23 or 24 weeks in a row, of which only one of those weeks has been under 1 million. Back prior pandemic, 200,000 was considered pretty normal. So, you know, when I look at this whole thing with the numbers of people unemployed, you look at the markets going straight up, something's got to give, okay? I just continue to watch this, and it's pretty impressive, okay? Moving on here, personal income and spending continues to be up. You say, well, Craig, personal income is rising and spending is rising. Well, that is the case for the last 3 months. Let's get into what is really causing that, okay? This is what gets very, very interesting. Personal income and spending rose by 1.9% in July. The consensus was 2%, all right? The week prior to that was up 1.6. Here's what's causing that. This is still highly dependent on government support. Craig, you ask why? How do you know that? Well, if you look at for the month of July, 17.4% of the income last month, which was down from 24.9 in April, was a result of government giving, handouts, unemployment. So that's not a really good number. So that's where when you say, hey, spending went up, and you'll hear the economists on TV, oh, wow, spending went up. Savings went up. Savings, just to highlight that, personal savings fell to 17.8%, down from a high of 33.7% in April. We have not seen numbers like this since the Depression. All right, this is a big deal. So what's happening is you've got this teeter-totter, this fine line of you've got a lot of people still unemployed, you've got the government passing out funds. They're trying to create this magical relationship, which is going to be a really hard one to accomplish going forwards. I really think from September forward into the fourth quarter is when the challenges are really going to rise, because what we're starting to see now is white-collar unemployment. You've seen the airlines going to put thousands of people, 16,000, 6,000 on another one. MGM just said that a lot of furloughed employees are going to be terminated, 16,000. Unemployment's going to remain elevated, all right? And that's going to continue to put pressure on a lot of things, okay? Moving on, the banks. Fed Chairman Powell praised the banks and their capitalization. If you go back to 2008, a big problem during the global financial crisis was banking. Banks were not well capitalized, and that put significant pressure as things started to crater. It is true, banks are not the epicenter of this crisis, but they are also not part of the solution. You see, not only banks are tightening, or not only were banks tightening lending standards for all types of loan at the fastest pace since the global financial crisis. You're like, what do you mean? It means it's harder to get a loan. Okay, they have increased the standards, meaning they are lending to fewer people or only people with really good credit. That's where those are the people that really get the good interest rates. Okay, so is it a level playing field? I would say the banks are really making it hard to get loans right now. The coverage ratio, this is another thing they look at, because after post financial crisis, they made banks set aside funds to cover certain percentages of debt and things that they had outstanding. Right now, that ratio has climbed to above 200% for the first time. Golf clap. Bravo. No. You know why banks are right now highly increasing their coverage ratios? They're really bracing for a serious amount of defaults, because you know what's rolling off the table? Protection for not paying your mortgages, protection for not paying your credit cards, protection for not paying your auto loans, which are all approaching financial crisis levels. Banks are preparing for this because they're like going, you know, this is probably not going to end up being a good thing, and we don't want to stand there, get caught holding the bag, basically. So they've been increasing their coverage ratios to prevent or protect in the event all these defaults start happening. Okay, that is not a good thing. So banks, you know what? Shamey. Another thing, if you look at credit card interest rates they charge you, so if you put money on a credit card and you don't pay it back, I think on average those rates are up approaching 20%. What's been fascinating is we are at a virtually a 0% interest rate, but yet they're still charging you interest on your credit way up here. Shamey. That's all I can say. I'm moving on here. The Federal Reserve, big announcement this week. And as expected, Chairman Powell stood up there and confidently said they are shifting their policy to be more accepting of inflation above their 2% target. Whenever you hear targeting, that means manipulation, by the way. Let's just call a spade a spade. What's fascinating is for the last 12 years, we've not seen inflation north of 2% more than 2 times. Once back in early 2012, another time mid 2018. Outside of that, inflation's really fallen off the planet, or fallen off the cliff. Bang. Okay. Here's what's interesting. They talk about the Phillips Curve, which you may or may not have heard of that. What it is, the Phillips Curve is what the Federal Reserve has used to track inflation, meaning inflation has a direct correlation to unemployment. They are inversely related to each other. So historically, as employment rates fall, you've seen inflation rise. Why? You have a full employment workforce. People are out spending money, driving prices up. Okay. On the flip side of that, as unemployment would rise, you would see inflation fall, except for one time. When was that? The 1970s. What is that called? Stagflation. What have I been talking about for weeks now? Stagflation. What is happening? We have the US dollar being devalued. What Fed Chairman Powell has basically come out and said is we are going to hold interest rates virtually at zero for the foreseeable future. We are going to continue to backstop this economy, and we are going to basically what that means is it's going to continue to drive the value of the dollar down. What do we need to own when you see the dollar declining in value relative to other currencies? Survey says gold, bing. Commodities, bing. Treasury inflation protection notes, bing. Technology, bing. Those are the four of the major things that we need to think about owning. For those of you that have 401k money. You need to look inside of it and see if you have things like that. Probably not going to have gold, most likely not going to have commodities unless it's my 401ks that I manage. You're welcome. Most likely not going to have tips unless it's my 401ks that I am managing. You're welcome. Probably may have a tech, may have a large growth, may have a NASDAQ. Those are ways to get exposure, gain exposure there. Other areas that will do well in the event of a declining dollar from a valuation standpoint, emerging markets. EM may or may not be in your 401ks, okay? Something to look for, okay? It's okay. We're going to be all right during this time. COVID, what's going to happen? Who knows? Is a vaccine really going to be that hugely impactful? Probably not. Is the flu vaccine really impactful? No, people still get it. The positive is we're learning how to treat it. So going forwards, looking at it from an investment standpoint, economy is challenged. We have high unemployment. That is probably and most likely going to stay elevated for quite some time. That's what we have to watch. Continue to watch the dollar. Continue to watch what is happening with the prices of goods and services. Grocery prices going up, not getting any cheaper to go to the grocery store. That's going to kill these people who are unemployed. Do you see what the government is doing? They are killing the people who are underemployed or unemployed because it is more expensive to go buy the things that we need. For Friday, August 28th, Wall Street X's and O's. This is Craig Modelmog. Thank you for staying with me this week. If you haven't joined or followed my deal, follow it. You know what? We're starting to gain some followers. It's kind of fun. It's kind of funny, actually. But anyway, I appreciate you guys. I hope you find this information helpful because I want to drill down to the facts. I want to focus on the facts. I want to help you be better investors. We're not going to panic. We're not going to make decisions with our emotions. We are going to make our decisions on sound financial, macroeconomic indicators and facts. Spit it out. I know it's late on Friday, and this is Craig Modelmog. And guess what, people?